The PE ratio takes the price today and the trailing 12 months of earnings to justify whether this is an industry average high or low PE. So if you were to base Tesla on pure EV manufacturing, it would take Tesla 70 years to pay back an initial investment today. But there lies the problem, because if you only look into the next 2 quarters, the earning potential isn't going to change materially. You've got to be able to look into the next 2 years to understand the businesses and the revenues that this company are about to generate. The problem with Wall Street is they don't look too far ahead of their toes. What you have the chance to be able to do is to look really far into the horizon and see these extremely high growth Easter eggs that are hidden away in this company that's valued as an EV manufacturer. They're a semi-truck maker, they're an energy storage deployer, they're an auto bidder service provider, they're a robo-taxi ride hailer, and they're an Optimus humanoid robot scaler. Therefore, these future business lines massively justify the high PE of 70 today. And so in this video, I want to look at some of the most incredible research from Søren Basher, the best analyst when it comes to understanding Tesla. He breaks down the future share price, breaks down the future earnings per share, he breaks down the present value of earnings per share, he breaks down why PE ratios are a dumb way to understand growth companies. You're never going to be able to catch the growth if you're basing your evaluation on the past. You have to be able to look far enough ahead. And the luxury of being a retail investor is you have the luxury of time. Whereas an analyst who works for a massive institution on Wall Street, they have quarterly performance that they have to meet. And therefore, they never manage to catch these opportunities like Amazon and Apple and Nvidia. They always miss this. The Palantirs, the Metas, they never manage to catch that future growth. So, like, comment, subscribe, let's go. The first data point that I'm going to look at is the sum of the parts valuation. And Søren breaks down all of the companies and he uses very conservative inputs to draw conclusions on what this company are going to generate. And I'm just going to look at 2030 numbers. The auto business is going to be generating 810 billion. The semis are going to be generating 105 billion. The energy storage is 960 billion. The services and other are 75 billion. The robo-taxi is going to be over 14 trillion. The Optimus is going to be over 30 trillion. Autobid is going to be 149 billion, and the AI inference is going to be about 5 billion. When you take these future revenue streams generating extremely high marginable operating profit, you can justify a high earnings ratio today. You could go even higher, above 70, because what the sum of the parts evaluation model shows is that the growth is so exponential that you'll be paid back your initial investment way sooner than most analysts expect. That looks at these trajectories when it comes to the share price, and we'll just go for the next few years, so 2026, 2027, 2028. And based on these inputs, if you were to take these future revenues and just really think about what they'd be worth today, you've got in 2026, 576. You've got by 2027, 1,445, and by 2028, 4,237. These numbers start to go extremely exponential, and therefore a price currently at just over 300 for Tesla is an opportunity of a lifetime. In this chart that Søren Basher illustrates, I want you to see how he shows how the earnings are exponential for the next 10 years. And then it starts to flatten out. And this is also mimicking what Nvidia did. Nvidia started its exponential climb after showing one quarter after quarter growth in earnings. This preceded the 1,000% move into the thousands pre-split at 10-1. Tesla is showing the same trajectory, but on an even bigger scale. This log scale is showing serious growth based on conservative projections of what the future business lines will produce. When you see these opportunities and you see this growth, there is going to be lumpy quarter-to-quarter earnings for specific business lines as they start to become more mature, like the energy storage. If you smooth this out and you go on a year-to-year basis, the growth is exponential. The next chart is the present value of the earnings per share based on these business lines being able to execute and scale. Wall Street often miss the middle part of this chart because they focus too much on the front side, the first 2 bars. They're so focused on the quarter-to-quarter earnings that they're never able to see the material improvements in the business lines that are going to lead to the growth. The other side of this chart, the right side of the chart, is less relevant because it's so far into the future. And what you're trying to capture with the Nvidias, with the Metas, with the Amazons, with the Palantirs, with the Hims and Hers, the Taiwanese semiconductor companies, you're trying to capture that middle part. They have new business lines, they have new products that they're scaling. What's the value of those businesses per share if you were to bring them to today? As Wall Street focus on the left side of this chart, they miss the middle. They don't have the luxury of time compared to a retail active investor. They need performance now, and so don't capture the precursor move as we approach the middle section of this chart. The sum of all these blue bars that determines the present value of Tesla stock today. If you bring these bars back to the present, you can see the value should be much higher when you factor in these businesses. So to simply focus on what they're currently doing, which is manufacturing cars, deploying energy storage, not at scale, they've got a small services business. This isn't really going to justify a PE ratio of 70 when you've got a company like Ford that have got a PE ratio of 5. It's just not going to make sense in the auto industry. But if you start to factor in these other opportunities, the research and development capex that they've put into the cybercab, the robotaxi network, the neural end-to-end networks, and the data storage required to process the compute to be able to create the FSD on the roads, and the humanoid robots that they're scaling, you see that the opportunity is in the future. This last chart by CERN really illustrates how the PE ratio can actually be quite intimidating. When you stare at it from that perspective, you think, how am I ever going to get my investment repaid based on these current businesses? But he shows how, as these businesses that are actually going to produce the growth start to materialize and scale and be executed on, the price earnings starts to drop down massively. And by that second year, if you can get past that initial high earnings ratio, you see how it reduces and it continues to drop to the point where you get your share repaid within a year. You can see how by 2029 and 2030, the repayment of that share is within a year to 2 years. And then by 2035, it's in 2 months. So these are the opportunities, and this is the hurdle you have to get past when you want to understand high growth companies. Because if you just value these companies on the PE ratio, you'll never be able to capture the opportunity and the growth that is expected in the future. So how could all of this be relevant? Well, there's a really good book by Peter Lynch called One Up on Wall Street. And he takes the PE ratio and compares it to people, actors, for example. He takes Harrison Ford as someone you would consider a high PE ratio. Because at the time, before Harrison Ford got the job role as Han Solo, he was just working as a carpenter, making maybe $50 every few days. How can you justify a high earnings ratio for this person? He's not done anything special. But what happened soon after is he got this role for Han Solo in one of the biggest franchises ever and made millions. And his earnings went up thousands of percent in a matter of years. If you had invested in Harrison Ford as a carpenter, you would have been able to capture that growth. But you're not to know exactly what's going to happen. But if you look at Tesla and you look at high growth companies like this, you can see that if you understand that Tesla could execute because they've got the right administrative team, they've got the right engineers, they've got the right leader and the CEO, Elon. If you believe that they're able to make the robotaxi, the humanoid robot scale and work, then you're looking at a Harrison Ford just before he got the role in Star Wars as Han Solo. Therefore, I believe that the share price this year will stay around 300 to 400 in this range, in this share price corridor. And this is a chart by AJ who really analyzes and studies the PE ratios and the business lines and the profit and the EBITDA, earnings before interest, tax, and amortization. And he really does calculate quite specific ranges. And this is a narrow range, but I don't think it really starts to climb until 2026, where the robotaxi network starts to really meaningfully move the needle for Tesla's business lines. And then after that, it just starts to shoot up. So I hope you got some value from this video. I hope that you're As excited as I am about the future of this company, I believe that this company will be the most valuable company in the S&P 500 in the next few years, and it will surpass Nvidia. And it's an extremely wild shot, but as I learn more about this company, I get more excited. I learn about other companies through learning about this company. So if you enjoy exponentiality, if you enjoy technology and the future and just seeing the world change, then continue on this journey with me. So like, subscribe, and I'll see you in the next one. Thank you very much. Bye.